Corporate finance practice problem using Excel. Sale of depreciated asset and tax impact. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left-hand side, we're going to populate that into the blue area on the right-hand side. We want to take into consideration now what would happen when we sell something that's a depreciable asset, a fixed asset, a long-term asset that has been depreciated basically for taxes, to consider the tax implications and the cash flow related to them. Now, this is a very complicated topic. It can change from year to year. The tax code can change from year to year, but it's something that we want to basically keep in mind when we do our cash flow projections and we do the best kind of estimates that we can, taking into consideration the significant components, which include the tax component. So when, for example, we're thinking about a long-term project, if we're thinking about the investment in something like a piece of equipment or something that's going to be depreciated, then we saw in prior presentations that we need to consider what the tax impact will be of the depreciation that we take, which will have a positive tax impact because the depreciation will be deductible. But if we plan on selling that asset basically at some point in the future, we also need to take into consideration what's going to be the tax implication of the sale. If we have a gain, for example, on the sale, then we might have tax implications on the gain of the sale, and that would be kind of a bad thing for taxes because now we'd have a gain that would possibly be taxable. Again, this could get quite confusing because oftentimes, for example, the IRS will change the law. They might try to stimulate the economy in certain times by allowing more depreciation up front. And you can see right now, even still, just in normal times, the depreciation for some time has been front-loaded using a double declining method, allowing us to basically depreciate more in the beginning and possibly adding bonus depreciation, allowing us to depreciate more in the beginning part of the depreciable asset's life. That means that when we sell it, we're more likely to have a gain that will be a result of the sale because now we've taken the depreciation in the front end. We kind of took the benefit of it. And so then we have to think about the tax result of the gain. Also note that sometimes you might have a situation where the tax rate is different between the sale of something like a capital asset, like the depreciable assets, and ordinary income, the other corporate tax rate. And in those cases, it could get more complex because of a different rate. And it could get complex because they might say that you want to recap some of the gains and this kind of thing that'll happen. So it could get quite complicated. We won't get into that now, but you want to just basically keep the concept on both the depreciation tax impact as well as the tail end that could happen with regards to possibly a gain if you sell the equipment at the end and you're trying to figure out the cash flow and the tax implications for it. So let's consider 5-year maker's asset purchased for $200,000. Purchase year in the past, we're saying it was purchased 3 years ago, and now we're going to sell it, right? We're going to sell it, and we're going to say, all right, the tax rate is going to be the 30%, and we assume the sale is either at $40,000 or at $75,000, and we'll calculate basically kind of the tax implications and the gain or loss that could be applicable to it. So let's do our calculation for the depreciation. Now, you could look at publication on the IRS website. You can look at publication 946 to get more information on the depreciation. You can look at table A1 in order to look at the percentages for the depreciation. I'm going to recalculate it, basically assuming a double declining balance half-year convention, which is the general rule for the depreciation. Remember, it could also change. You could have more depreciation up front depending on the year that you're putting this into place and whatever the tax law is doing at that particular time. But the bottom line, the basis that's been down for some time is that maker's depreciation here. So we'll use that, but I'm going to recalculate it and try to give an idea of what is actually being calculated. So let's see if we can recalculate this to some degree. This is an estimate. So we're going to say the cost is going to be the $200,000. We'll say the number of years that it's going to be depreciated is 5, even though we're going to sell it after 3 years because it's a depreciable asset for 5 years. So I'm going to underline that. If we were going to have the straight line depreciation then, calculating then the straight line depreciation, it would be 200,000 divided by 5 or the 40,000. Now that would be in dollars. If I want to think about the percent of straight line, then I would compare that to the cost of the 20,000, underlining that, font group and underline. That would give us a straight line percent equal to 40 divided by the 200, or numbers group percent 20%. You can also calculate that by saying 1 divided by the number of years, 5, and percentify that. We once again get the 20%. Closing that out, and then we're going to take that 20 and multiply it times 2 because it's basically a double declining method. Font group underline, and that's going to give us our double declining percent, double D percent, double declining percent, 20% times 2, making that a percent, numbers group, percentifying it, that's 40%. Then we're going to take that times our cost, which was the 200,000, underlining that, font group and underline. That's going to give us then our double D depreciation for the year if we didn't have a half-year convention. Double D depreciation for the year then, it's not happening, hold on a sec, is there, equals to 40 times the 200. And then there's a half-year convention, meaning no matter when we bought the equipment, normally, there could be exceptions to this rule if you bought it all at the end of the year, but normally, there's a half-year convention saying that we bought it in the middle of the year. So we're going to divide that by 2 for half of the year depreciation for makers. And that means in year 1, we're taking the 80 divided by 2. That's 40,000. Comes out to the same as the straight line, but be careful, it's not straight line. It's double declining balance half-year convention, which will become apparent if you then pull it out to year 2, because you can't do the straight line thing in year 2. We're going to take the double declining rate, 40%. Basically the book value for tax purposes, in other words, the cost minus the depreciation. Underlining that, multiply it out, 40% times the 160 is going to give us the 64. There is no half-year convention in year 2, so that is it. 40%, let's do it again, and then make that a percent. Now we have the 160, the prior book value minus last year's depreciation is going to be the next book value on a tax basis, meaning cost minus accumulated depreciation. Underlining that, multiplying it out, we got the 40 times the 96. Bringing that on down, we don't have any half-year convention, it's the whole year. The entire year, once again, 40% for year 4, moving on to year 4. And now we have the 96 minus the 38.4. Underlining that, then we got the 57.6 times the 40% gives us the 23. And then the last two, they kind of deviate a little bit, so we'll deviate a little bit from our double declining. We're going to say that we're still going to take the 57.6 minus the 23.40, but I'm just going to use the same number, and I'm kind of mirroring what happens in the double declining here, where they got these last two that what are basically the same, meaning the tax code's doing something a little bit funny there. If you use straight double declining, it would probably be okay for an estimate, because these are estimates here, projections usually. So then we're going to say, all right, and then the last one is going to be the 34,560 minus the 23.40. Now, obviously, if this wasn't a projection and you were actually had a sale and you're looking at the taxes, then you would be using tax software to do that. And the tax software would help you greatly to figure out what your gain or loss would be in that year. But if you're projecting out something into the future and you're trying to say, well, what would happen if I purchased it and then I depreciated it for 3 years and then I sold it, then that's a lot more difficult to project out, because now you're trying to think three years out into the future and think about what the tax impact would be on both the depreciation and the sale. And that gets much more complicated. So once we have that, then we're going to say, all right, let's say we sold it after 3 years. So now we got to figure out the book value on a tax basis, meaning cost minus the accumulated depreciation on a tax basis, which will differ than the cost minus accumulated depreciation on a book basis if we're calculating the two things differently, which most large companies would do. So we're going to say, all right, and again, you might have this in the tax software. The tax software could really help to tell you what, where they might have depreciation schedules to kind of help you out where you're at once you actually make the sale. But if you're trying to project out into the future, then it becomes a little bit more difficult to do those projections from there. So I'm going to say, all right, we sell it for $40,000. That's our first assumption. We sell it for $40,000, and then we have the depreciated cost, which is kind of like, the book value, I'm saying, which is going to be book value on a tax basis, meaning the cost minus the accumulated depreciation. So the cost of this thing was equal to the 200,000. And then we're going to say the less, I'm just going to call it less ACC depre, which is accumulated depreciation, which is the depreciation up to the 3 years. So if we sold it after 3 years, then the 40, the 64, and the 38.4 would be the accumulated depreciation up to that point. So I'm going to say this is going to be, I'll make it a negative SUM of the depreciation for those 3 years, year 1, 2, and 3. And that's going to give us our depreciated cost. And then we'll sum this up equals the SUM, which is going to subtract it out, the 200 minus the 142.4. Put an underline here, font group and underline. Underline here, font group and underline. And then we'll say this is going to be a loss that took place. This is going to be equal to the 40 minus the 57.6, and we have a loss. Now again, that could happen. We might have a loss, in which case we have a tax benefit. But realize that because of the front loading of the depreciation, the more the front loading of the depreciation happens, double declining is a front loaded basis. And if there's any added front loading, meaning you get to depreciate more, special deduction 179, for example, deductions in year 1, the more likely it is that when you sell it, you're actually going to have a gain because basically you took the depreciation even though the value of the thing didn't go down because they allowed you to take more depreciation up front. And so just realize that that's often quite possible. But if you have which we'll do in a second, but if you have a loss, then we can take that loss and there's going to be a tax benefit to the loss typically. Take in the loss times the 30%, which is the tax rate, which would be 30%. In this case, we're saying 30%. And then again, we got to be careful on what rate to apply here on the taxes as well, but underlining that. And that's going to give us our tax benefit. Tax benefit, which is going to be the 17.6 times the 30. So remember, obviously for taxes, losing money is good for taxes, right? We at least get a deduction for taxes. So that would be a tax benefit. Now, what if we had a gain? Let's do the same thing and say we had a gain. Well, we'll say, all right, gain side of things, we're going to say the sales price. We're going to say now we're selling it for 75. And again, I would assume oftentimes when you're doing the projection, the gain can be quite likely if you assume that you're going to sell this after 3 years for 5-year property, which you got to front load the depreciation on, because you're likely to have a gain then because you depreciated more than you otherwise would do just because the tax code allowed you to do so. So we're going to say this will be the 200,000 then. The 200,000. And then we got less the ACC depreciation, less ACC depre, which is going to be once again negative SUM of the depreciation for year 1, 2, and 3. So that's the same 142.4. That's going to give us our depreciated cost equals the sum of these two. Let's put an underline there, font group and underline. And that gives us our tax loss on sale, which is going to be equal to the 75 minus the, I'm sorry, this is a tax gain on sale. This is a gain on sale. And that's our 17.4. So now we have a gain, and that can have a tax burden now, because now we had a gain. And again, it's quite likely to do that. It's nice if we get the deduction up front, right? We got to over depreciate. You can think about why did we have a gain here if we sold it for 75? Because we over depreciated. We got this tax benefit of the 142 in the first 3 years. We got to deduct that, and basically by devaluing the equipment past what it kind of should have been devalued at. And then if we sell it, we're going to get the money back. But now we have this gain because now we have the depreciated cost, which is less than what we got it back for. And we got to make sure that we take that into consideration and the tax impact of it when we do the taxes. So now we're going to say that we have this tax gain on the sale, which was 17.4, and we'll multiply that times the tax rate, which Again, it could be more complicated depending on, what the rate is and whatnot. But general idea is we have the tax impact of the gain that we're going to have to deal with. And that's going to be our tax benefit. So this is going to be the 17.4 times the 30. And there's our 5,220. We have to take that into consideration. So when we're thinking about our long-term projects and we say, okay, we're going to buy this 5-year piece of equipment, we're going to depreciate it, especially if we're depreciating it or buying it because the tax code is trying to stimulate the economy by allowing us to depreciate it all up front, then we're going to have a huge benefit to take the depreciation possibly up front. And then if we expect to sell it in 3 years, we got to make sure that we take into consideration the tax impact of the possible gain that's going to happen when we sell it after that 3-year time period, because we've over depreciated because the tax code allowed us to do that. So we got the benefit up front. If we sell it, then we might have a problem at the point in time that will take place. We got to take that into consideration for some of those long-term project considerations.